You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live every Friday at 1:30 p.m. Central, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by QuickStrike, options pricing and analysis software. QuickStrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. QuickStrike has you covered, with market data reports ranging from open interest to the term structure of volatility. QuickStrike is the perfect addition to your trading toolkit. Learn more about QuickStrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1. This Week in Futures Options is also brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody, that music means it's time once again for TWIFO, This Week in Futures Options, a program where, pretty self-explanatory, we break down the week that was, and in some cases still is, on the other side of the fence, the futures options, talking the commodities, the metals, some of the index futures and the financial futures, as well as some other fun products mixed in there as well. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the old Options Insider Radio Network. And if you're listening to the full network stream, we love you, we like you, have fun, keep doing what you're doing. If you're listening just to TWIFO, there's a whole new world of shows out there for you, daily news shows, all sorts of other fun programs, 15 of them to be precise. Easiest place to get all that, of course, the mothership, theoptionsinsider.com, or just subscribe to our full network feed wherever you listen to shows. Could be iTunes, Stitcher, wherever you get this fine program. You can upgrade, do yourself a favor, upgrade. You can grab our mobile app as well. It's all baked in there as well. And of course, for you hardcores out there, put out a nice little fun bonus every Friday, 1:30 p.m. Central, 2:30 p.m. Eastern. You can listen to us live. It's really fun. So join us there if you're around and you're into the old futures options landscape. I'm guessing if you're listening to the show, you probably are. And of course, you can always hit us up wherever you are, however you listen. Hit us up, questions, comments, insights, points of contention, whatever you got on your mind, hit us up. We do like to hear from you guys. And joining me on the old program today, my usual cohort, my partner in crime, the technology yin to my yang, Mr. Nick Howard, the founder of Bantix Technologies and creator of a little platform we like to use once or twice around here called quicktrike. Mr. Nick, welcome back to TWIFO. Sir, how you feeling on this fine Friday full of futures options?
I am back in town. Missed last week. I had a couple no-shows the last month, so that's not good. I felt a little bit bad about that, but here I am, ready to go.
It means you got to do double duty this week to make up for last week and the last couple of weeks. So there you go. You ready?
I'm going to just listen to Erik today. I'm listening to Erik all day today.
That's a good way to proceed as well, because joining us in the CME Group hot seat today, listeners, an old friend of the show, even though he hasn't been on in a while, and appropriately enough, someone from CME in the old CME hot seat. He is Erik Norland, the executive director and senior economist over there at CME Group. Erik, welcome back to TWIFO, sir. It has been too long.
Yes, thank you so much for having me back.
I know you've been traveling quite a bit. You were across the pond for a while, but now you're back U.S. stateside, at least for a little bit. So I'm glad we could grab you before they ship you back off across the pond. Let's get into it, Erik. The reason we like to bring you on, you're as scintillating as you are, is because you usually come equipped, you come armed with some of the latest research into all sorts of different product fields. That's probably why you guys like being at CME, quite frankly, as an economist, because you have so many different product categories to choose from. These days, you seem to have set your sights on gold, including your latest research, gold risk from diminished rate expectations. Obviously, gold's been on fire a lot the last few weeks. It's been rallying. This week, not so much, taking on the chin. The future's off about 25 handles, right around 13 and a quarter or so. So a lot to break down there. And Erik, what's caught your eye out here? If you'll remember, of course, I think it was about 2 years ago when you first came on our network, you had what I think is still one of the best timed research papers we've ever discussed on our network, which was, of course, gold volatility. Is there a storm on the horizon? And of course, we saw gold vol just explode. I think it was 3 days later, so it couldn't have been more well-timed. So listeners, if you're interested in gold, even if you're not, pay attention to what Erik's got to say on this product. Erik, what caught your eye out there in gold, and what was your paper about?
Well, so what I think is really fascinating is that gold, silver, and platinum have all become extremely highly correlated to our Fed funds futures. Fed funds, as I'm sure you all know, is a future that allows people to hedge themselves against the average level of the Fed's target rate during a given contract month. And so those futures have been moving a great deal. A few months ago, back in March, just before this whole rally in precious metals got started, the Fed funds futures is basically saying that by the end of this decade, so by December 2019, that Fed rates were going to be up towards 2%. Since then, there's been a sea change in Fed's expectations. The Fed funds futures now saying that by the end of the decade, the Fed will be probably below 1.5%, maybe around 146 on average. And so what that means is that between now and the end of the decade, instead of raising rates another 3 or 4 times, the Fed will only be raising rates 1 or maybe 2 more times. And that has just been great news for gold, silver, and platinum, but particularly for gold, since gold has the strongest and most negative correlation with Fed funds futures. Now, that gold correlates negatively with Fed funds is not a new thing, but over the past 4 years, that correlation has become steadily stronger. Back in 2009, 10, 11, 12, when interest rates were stuck at zero and seemed like they would be there forever, gold wasn't very strongly correlated to Fed funds. But as the Fed began to talk about tapering and then eventually talk about hiking rates and eventually actually hiking rates, that correlation has become something like negative 0.6 or negative 0.7 on a day-to-day basis for the past 12 months, which is a very, very powerful correlation. The correlation for silver and platinum is just behind that. It's like negative 0.5 for silver, negative 0.4 for platinum, again, measured over the last 260 trading days, so roughly the last year. And those are very, very strong correlations. And so essentially, as the market has depriced these Fed rate hikes that it had thought were going to happen and no longer really believes in, that's been great news for precious metals, which of course are stores of value arguably currencies that don't pay interest. And so since they're competing with a fiat currency that's issued by a central bank like the U.S. dollar, as that U.S. dollar becomes less attractive because it's expected not to pay its holders as much money, it makes precious metals relatively more attractive.
Now, you're right, that correlation has kind of with the Fed and, of course, with the metals too, the Fed action has always kind of been there. It's obviously a key driver. That's why we see gold moving around all the time whenever the Fed is active. And a lot of these big macro events tend to be drivers for gold. This week, obviously, not so much a little bit to the downside. Action, I guess, the perhaps not as great impact from Irma and a lot of the fears from last week not materializing. Irma not really being perhaps as destructive as they thought. Jose heading off to whoever the heck it's heading off to, and perhaps North Korea not being as scary, all of that perhaps combining to give gold a little bit of a breather this week. By the way, listeners, if you haven't checked out Erik's research, you should do. It's over there at cmegroup.com. Click on the research. You can find his name. Just search for Erik Norland there, and you can find as well some great visuals that really kind of sell the story here of what we're talking about, including a good graph here about the Fed fund futures 1 year out and 2 year out. You can kind of see these inversions for yourself. Sometimes it's a little hard when we're talking about this stuff to really kind of visualize it for yourself. If you see it here in the visuals, it works also with I know Nick, you guys over there at quicktrike have a good tool this as well. Also on the CME site, it's your dot plot effectively showing what the Fed and FOMC participants are predicting for the next couple of years, and all this seems to concur. Do you agree, Mr. Nick?
Yeah, I had sort of a comment and then a question for Erik, because clearly he's able to speak to it a lot more appropriately than I can. But if I'm just cheating and looking at the Fed Watch tool that's out on the CME Group website, in the farthest that's currently available out there is the August meeting, but the highest probability at this point is a target, between 1.25, 1.5, which puts us about 0.25% higher than where we are right now, which speaks to what Erik has been saying previously today. But Erik, when you look at the dot plot that becomes available based on what these guys and gals on the Open Market Committee believe will be the case going forward, how do you account for the difference in their stated opinion versus what the futures are saying?
So yeah, it's really interesting. So the dot plot basically measures what people on the Federal Reserve think rates will be at in the future. So why is it so different than the market? Well, first, there's often a gap between what the Fed thinks it's going to do and what the market believes. It's just that the gap usually isn't as big as it is right now. The gap is essentially about as big as I've ever seen it. The Fed is usually very optimistic about its ability to raise rates. I don't know why it is that they think they're going to raise rates. I don't know if their models are broken and they think the economy is just going to grow faster than it really is, or if they if there's something they're not taking into account. I mean, one factor I think that they may not be taking into account is the level of debt in the United States. We all know the public sector debt's really high, but the truth is the private sector hasn't deleveraged very much since the crisis. So that kind of limits how much a central bank can really move interest rates. The only way in which that debt can be financed is through very, very low interest rates. There's really been no deleveraging at all since the end of the financial crisis, which I think in part explains the slow growth, but I think it also in part explains why the Fed has such a hard time moving rates up. Another factor is we just don't really have very strong inflation. So the Fed keeps thinking that, well, because unemployment is low, that therefore we should have more wage pressure, which should drive inflation higher. That doesn't really seem to be happening because the wage pressure is not all that strong. Some of that may have to do with the fact that technology is advancing really quickly, which makes people too insecure to ask their employers for higher wages. We also have a very open economy. Jobs can move abroad pretty easily. So you also have the free trade constraint as well on wages. But for whatever reason, there's this really big gap. But there's one other reason, too, which is that most of the people on the FOMC currently are not going to be there in 12 months. Stanley Fischer just announced that he's leaving. He was the number 2 in charge. Janet Yellen, as we know, her term is going to come to an end in January. I happen to think that President Trump might reappoint her as I understand it, the two of them get on pretty well. The economy is doing well. He might not want to rock the boat. And I think his main alternative, Mr. Cohen, Gary Cohen, who's serving as a chairman of the Council of Economic Advisors, maybe has dropped a little bit in the president's esteem. So I think she might get reappointed. But even if she does, most of the other members are their terms are coming to an end. So, in 6 months' time or 12 months' time, we're going to have a very different FOMC. So who cares what the current members think about if they're not about future rates, if they're not going to be around to vote on them, if somebody else is going to be taking their place? So that may also explain some of the size of this gap.
See, Eric, I honestly, every time you're on, I could just sit and listen, to be frank, because I learned so much from the reports that you put out, as well as just, I look at I don't know the fundamentals so much, but I look at the numbers and I do the comparison. So for me, that's the first thing when I saw what the expectation was in 2 years versus what that was saying. I thought that was a fairly striking difference. So maybe we should consider doing something that even plots what the Fed committee expectation versus what the futures are doing. That might be an interesting plot in and of itself to add to the Fed Watch tool. So that's something I'll have to speak to Ted over at CME and see what he thinks about that. But thanks for that explanation. That's a great explanation, and I think it's obvious when you go look at the probability bars on the tool. It's obvious that we're going to be pretty slow slope in terms of the growth of that rate.
Yeah, I think that's right. There's one thing I'd like to point out. One thing that's happened since that paper was published. One of the things the paper warns about, that I think is still very pertinent to anybody in the precious metals markets or the interest rate market for that matter, is that Fed funds futures were going to risk going up in terms of yield, in part because the actual state of the economy hasn't really changed very much. The economy continues to grow at about the same pace now as it's been growing for the past 7 years, which is to say a pretty steady but not spectacular clip. And so the Fed funds futures depriced, if you will, 70 basis points worth of rates hikes between March and now, which was on a day-to-day basis the main driver, I think, of the rally in precious metals prices. But since that paper got published, we have seen a reversal. So the Fed funds target rate expectation now for the end of the decade has come from 146 to 161. So it's added about 15 basis points back, which has corresponded with exactly that little sell-off that we've seen in gold and silver over the last few week or so that you mentioned at the beginning of the program. So there has been that little change. I think some of the reason why these rate hikes have also been depriced also has to do with the fact that there was this hope when the new administration came in that they would break the gridlock in Washington. But it seems like that gridlock is as strong as ever. So the idea that we're going to get a fiscal boost to the economy seems to have faded. But my guess would be over the next few months, the markets might decide, it doesn't matter if we get a fiscal boost or not, because the economy has been growing for 7 years. We've had gridlock since the beginning of 2011, really since the Republicans took control of Congress in the 2010 elections. We've had total gridlock, and the economy keeps growing. So you know what? The Fed can still keep raising interest rates. The economy is going to keep growing. And if that does happen, that could be bad news for anybody who's bought into this little rally in PMs.
Yeah, that was exactly my next question, was the expectation here, because if you go back and look at the 1 year chart, we're basically where we were last year at this time. So as much as we've had an increase over the last 3 or 4 months, we really are nowhere any different than we were just prior to the election, or the culmination of the election last year. So that's really my next sort of, if you had, what's safe here, right? The market just doesn't. We'll talk a little bit more about the vol curves and what the skew looks like, and what I think that's saying about expectation in terms of price range. But it really doesn't look like we have a big push higher in gold at this point. It just looks like, we try to slog it out, and there might be a little bit of a run up. But then I think what happens is people peter out on that run up, and then it goes back to the same old story again. Do you have? I know that you can't prognosticate about where the expectation in the market is, but do you feel like there's any steam behind it, or does it look like it's one of those things where, given all the parameters, we're going to have to wait and see?
Well, I guess in some ways you always have to wait and see. But I mean, my fear though is that the markets are going to start pricing in a little bit more Fed rate hikes. I mean, when it got down to just one more increase for the entire rest of the decade, that struck me as extremely conservative in terms of where the Fed might go. Now, I've never believed the Fed's dot plot that it was going to go to 3%. I always thought that was just pure fantasy. But the idea that they have to stop with just one more rate hike to get us into the 125 to 150 zone strikes me as too conservative. Now the market is essentially, as of this recording, is again, prices have moved a little bit since we published that paper. They're now saying 2 rate hikes. There's now kind of saying at the end of the decade will be between 150 and 175. That also strikes me as a little bit conservative. I think the Fed might go a little further than that. And if it does, I think that'll be a bit of a disappointment for anybody in precious metals.
Erik, I know this is not the subject of your paper here, but we're about to get into the options volume and hot options and volatility over there in gold in a minute. Before we do that, I think I'd be remiss if I didn't ask you your own opinions about gold. As I mentioned, you have weighed in on gold volatility in the past, including that much ballyhooed, very well-timed paper from a few years back. Gold coming off a little bit this week as we see gold moving to the downside, hovering in the 11 to 12 handle range, depending on where you're looking out there in the curve. So not quite anywhere near the historic highs we've seen. It's also not at the bottom of the trough there. Do you have any outlook on gold volatility right here? Has this been something that's been in your research of late?
Yes, I think it's very interesting to look at it. And so I guess it, of course, depends which maturity you look at. But basically, the levels of gold volatility are pretty close to their historic lows. They're not the lowest they've ever been in all of history, but they're not too far. They're a lot closer to the lows than they are to the highs. So anytime it's hanging out around 10%, you have to remember that sometimes it's been double, even triple that occasionally in the past. I think at this level of volatility, it's a little hard for me to imagine being a seller of options at that level. Now, buying options, of course, is a little difficult to say too, because there's always a question of timing. If you buy them too early in the market, doesn't have a big move, then it can expire worthless, which is not obviously your objective if you're long options. But I think that we're getting into the potential for much higher levels of volatility. But what I would point out is that we know that gold and silver options are trading near, but not exactly at their historic lows. That is true of a number of other markets that trade here at CME. And so those other markets are the fixed income markets, equity index futures, and the currency markets. Across those 3 asset classes, for most of the instruments in those asset classes, if not all of them, the implied volatilities on options are near record lows. So when you add metals to that, that's 4 asset classes out of the 6 that trade here at CME. So I think that that's quite remarkable. And what I think is particularly interesting about that is that I think that it has a common thread. Why is it that vol is so low across all these products? Well, the simple and not terribly informative answer is that realized volatility has also been very, very low. But then you get to the deeper question. So why is it that both realized and implied volatility are low? And I think a lot of it has to do with the massive amounts of central bank liquidity present in the market. Even though the Fed has now raised rates 4 times, interest rates in the U.S. are still very, very low by historical standards. We're at essentially 1.125% Fed funds target, which up until like the last, say, decade or so would have been considered extremely low. Other central banks around the world are still creating vast amounts of money. The European Central Bank is still printing 60 billion euros per month. The Japanese bank, the Bank of Japan, is continuing to expand its balance sheet. The Bank of England has rates at 0.25% that it's just thinking about raising. And a lot of smaller central banks like Switzerland, Sweden, Canada, et cetera, Australia, New Zealand, even People's Bank of China have interest rates at historic lows for their respective countries and currencies. So you have huge amounts of money being created. And what effect does that have on the market? Well, markets tend to behave in a very orderly, boring fashion when it's very easy for buyers to find sellers and sellers to find buyers. So essentially, when you have tons of liquidity, the price doesn't have to move very far at all in order to get orders filled. But I think the risk, though, for options in general, for metals as well as for these other asset classes, is that as central banks begin to change their course of monetary policy, as we've already begun to do here in the U.S., that over time the cost of options is going to go significantly higher. So I think that we could essentially go from the levels we've been trading at in metals and these other asset classes and quite literally double those levels for sort of average cost of options. And so the Fed, as we know, is going to begin reducing its balance sheet. They're going to make that formal announcement in later this month at their meeting. Unless something really drastic changes, they're going to start reducing the size of their balance sheet in October, which will be a little bit like a QE, but in reverse. I think, as we mentioned, that the Fed is likely to go a little further in hiking rates than the markets expect. The Bank of England has now signaled that they are going to start hiking interest rates, possibly as soon as this fall, or not maybe early next year. The European Central Bank is going to wind down its quantitative easing program. We don't have the exact date on that, but I think it is a near certainty for 2018 that that's eventually tapered off and comes to an end. The global economy is recovering, and so as the economy continues to recover, I think other central banks are going to take steps to tighten policy. China's cracking down on lending. None of this is going to have an impact of sending vol higher tomorrow or even next month. But over time, I think as central banks tighten policy, that typically over maybe the next 12 to 18 months, you could get a very significant rise in implied volatility. So, I think that these days of low vol are not going to last forever, and that the trend in volatility over the next year and a half is likely to be higher.
Hey, Eric, I have one question. So I know that the rates aren't necessarily in lockstep across the three places that you mentioned where the tightening may start or the QE might stop. Do you have any opinion about which of the currencies would be the strongest when that starts to take place, or will it continue to be the dollar?
Well, so the dollar's actually weakened a bit lately. So when precious metals rise, it's because you view it two ways. The value of metals is rising versus the dollar. You can also view it as the dollar is able to buy less precious metals, right? So the dollar's fell against gold, silver, and platinum. In the last few months, it's also dropped against other currencies, if you will, against the euro, against the yen, against the Chinese renminbi, against the pound, et cetera. All these currencies have been rebounding against the U.S. dollar, including our neighbor Canada, et cetera. And so a lot of that correlates very closely also with this move in interest rate expectations. As the markets came to expect fewer Fed rate increases, the currency market also, took the U.S. dollar down a couple pegs versus these other currencies. Now that those interest rate expectations are rebounding, and I think they got a little unrealistically low. I think people got too focused on what's happening in Washington, and they forgot that what happens in Washington doesn't matter as much as the news media claims that it does, or as much as policymakers in Washington like to believe that it does. The economy in the U.S. is growing just fine in spite of the gridlock that people had hoped would end under the current administration has been there for at least the last 7 years. So there's not really anything new. So I think the risk is that these interest rate expectations rebound a bit. And as that happens, the dollar might re-strengthen versus other currencies and against gold, silver, and platinum, which means that those metals would go down in price perhaps against the U.S. dollar.
Eric, we could keep talking about your research for a while. We have to dive into the actual options activity that's been lighting it up this week. So let's get into gold, obviously, because we're talking about gold right now. It's been an interesting week for gold, opened just up about 3%, so pretty much about an average week in terms of OI moves out there. In terms of what's lighting it up, the futures, like I mentioned, off about 25 handles this week. So the vol actually coming in. I know that's surprising to a lot of you who look at primarily equity and index options. I think downside equals more volatility, but as you said many times out here in gold land, and it's quite the opposite many days out there with the calls having the volatility bid, the puts having a bit of a discount. Hence, we're seeing a bit of a retracement from an overall vol perspective, as Erik alluded to earlier. Vol kind of on the lower end of the range. So if you're out there looking to quote unquote harvest the risk premium, maybe now is not the best time to be aggressively diving in. We can get more into that in a little bit when Nick gets into the quick skew as well. What's been going on out there in terms of a volatility skew, in terms of what's lighting it up, the hot gold options for this week. Number one with the bullet comes in October out here in the front month. We were saying, gold sold off, but it didn't stop people from piling into the 13 halves to the tune of about nearly 9,000 contracts this week. It actually was a lot of back and forth. So it wasn't people just net opening on the strike. It was pretty much even from an OI perspective on the week. So a lot of churn and burn, maybe opening earlier in the week and then deciding discretion, the better part of valor, maybe some combination therein. Either way, about nearly 9,000 contracts piling in with the lion's share coming on Tuesday, about 3,500. Then we have to go out to Dees, actually. Usually it's all front month all the time here for gold, but here got to go for Dees for our number two, which is a little bit closer, maybe the 1280 puts. Not quite. You think usually in gold you see even numbers like the 1300 puts lighting it up. This week, the Dees 1280s with 7,300, almost pretty much all of that coming on Thursday. 6,700 of those coming on Thursday, and a good chunk of that over half opening. So a lot of action out here on these 1280 puts. And we drop off yet again to the 1260 puts, also out there in Dees with about 6,700 contracts. Again, the lion's share of that coming on Thursday. I'm guessing from very similar numbers here. Looks like there might have been perhaps a bit of a vertical going up out there, the 1280, 1260. I'll have to confirm that with the block trade numbers out here in a little bit. Also looking out here, 1300s in the front month also were pretty active with about 6,000 contracts. So you take that one perhaps vertical skewing number out of the way, and all of a sudden 1300 puts are number two pretty robustly with about 6,000 contracts, about evenly split between Tuesday and Wednesday, almost 4,000 combining between those 2 days, and about 1,000 of those going up today. We also like to look a little bit farther out when we're talking about all things metals, and in terms of what's lighting up the tape out here for Dees and beyond, actually wasn't a heck of a lot. Usually we see a little bit going on, maybe some outliers. There were about 400 of the 1,200 puts going up, 450 almost, 1,200 puts going out in June of next year, and a 20 lot of the 10 half puts in Dees 2019. Other than that, not a heck of a lot of long-term, also not a heck of a lot of going on in the weekly. So the two extremes really not too active this week, but in the bread and butter, the front month, and then again in the Dees, that's where the lion's share of the action was. Nick, we were talking about gold vol earlier. I mentioned how it's been coming in this week with this downside move. What did you see out there in gold skew, or the quick skew, I should say, that may have caught your eye this week?
Yeah, well, as Erik was saying, and as you just mentioned, I'm looking at the 5-year, 30 and 60-day vol charts, and we are near, as Erik mentioned, we're not at our lows, but we're very near our lows that we experienced when the market was up in the $1,700 mark. But as far as what's going on, a couple other things. You mentioned the high open interest in the high volume strikes, but the other thing that generally catches my eye when I look at the this week in options report is I like to look at the put call ratio on the volume as well. So we see the calls are dominating in October and November, so that's in the 10 to 40 day expiration range. But then when we start to get out to the the Dees and beyond, we're seeing that the puts are dominating. So that could have been, still a little bit of, as Erik was mentioning too, a little bit of that short-term expectation still that we might have had a continuation on the upside, but maybe, that there is a look to the downside as we move further out toward the end of the year and beyond. So that's always something to, that number is readily available in the put call ratio column. It's always something to take a look at. The other thing of note, volatility, as you mentioned, off this week, and being and it's hard, right? It's not off a great deal from an absolute standpoint, but from a relative standpoint, it's quite a bit, right? So you go from 11 or 11 3/4 down to 10.5. That's a significant amount from a per net percent standpoint. So vol soft, and you would expect that as you see the market come off its current highs. Because a little bit of the exuberance you might have from that run-up is gone. The other thing of note is our quick skew numbers, which again, as we talk about every week, mention the relative richness or cheapness to the at the money. So we saw the puts get less inexpensive and the calls get less expensive. Now it's really important. That's why we do the quick skew in a a percent rich or cheap, right? Because it's so you can measure based on, you have a 10 vol versus a 100 vol, so you can measure accordingly. So, when you're looking at a call that's 2.4% rich when the volatility is 10%, that's really not telling you it's not that expensive from an overall vol standpoint. It's like a 0.25%, but it's still giving you the shape of what the curve looks like. But if we go out there and sort of look practically at October and November, even though the calls are bid and the puts are still cheap to the at the money, it's a pretty flat vol curve, more or less, a very, very small amount of slope between the 25 delta put and the 25 delta call. So we're seeing a little bit of throttling back where the calls are not quite as in fashion as the puts. But overall, if you're looking at very practically from a vol difference standpoint, you're not seeing a great deal of difference between the 25 delta put and the 25 delta call. So that's really sort of the big notice here, and that change, that tilt from the calls being less expensive and the puts being less inexpensive, that happened pretty much across the board. So that's obvious sentiment change based on the fact that we couldn't get through some of these key levels in the gold, and I'm sure we'd see the same thing in the silver as well, because we were starting to see that skew appear similarly in the last couple of weeks.
Yeah, that's a big deal, because how many times we've talked about on the show about, gold skew tends to move and tends to change, but it has been, there was that predominance to the calls for quite some time. Interesting to see that sentiment changing. So that's all of you out there who are looking for some sort of key, some sort of indicator on gold. Maybe that's it. Maybe that skew shift is the canary in the proverbial coal mine. We have to hop into crude, but before we do that, Eric, you got any last thoughts over there on gold before we dive into the Texas tea?
Yeah, I think I'm ready to dive in, except I would just mention, sort of on a day-to-day basis, the Fed funds futures correlate very highly with precious metals. But the other major influence, it seems to be mining supply. But that's not really a day-to-day thing. It's more of a year-to-year thing. But I would just point out that for gold and silver, mining supplies are at or near record highs. We're going to mine 97 million ounces of gold this year. So for those people wondering why hasn't gold gone higher up to 1,500 or 2,000 or something like that, I think the mining supply has a lot to do with it.
Speaking of supply is pretty much the order of the day when you're talking all things crude, and that's been the big topic post-Harvey and post this litany of hurricanes that seem to be pointing at us in pretty much unending fashion these days, is what the impact has been on the domestic supply. Of course, we saw most of the refineries, I think they said about 20% of U.S. refining capacity shut down post-Harvey, something that's starting, I should say, to really come back online. It's been an interesting week out there in terms of crude, with crude getting a little bit of a boost, ending the week over the 50 handle again, up about 2.5 to 3 handles, depending on where you're looking out there in the term structure. But a good week out there for crude. Before we get into all of the nitty gritty on the vol and the hot strikes and such, Eric, I've been following you. I've noticed you've been cheating on us a little bit here on Twifo. You and Blue have your own show, Off the Charts, so you guys have your own podcast stars. You don't eat us anymore, but you guys have been doing your own show, and I know you've been talking about crude a little bit there. But I know you're a guy who likes to watch, as you mentioned with gold, what goes into the structural elements of the price, so the actual cost of mining and producing and refining. Obviously, this is a big time for that sort of research. A lot of those numbers are in flux. What are your thoughts? What's coming out of that region, and what are your thoughts on some of the issues with production and supply and what we're seeing out there in crude right now in the wake of these many devastating storms?
Yeah, so definitely there's been a sharp drop in U.S. crude production during the week of the hurricane. It started to rebound last week. I think it's going to come back up to pretty much where it was before. So I think the market sort of discounted that as a temporary interruption. I don't think it's going to have a really big impact. But what I do think will have a big impact, though, is I think that in general, U.S. production is about to peak, at least reach a short-term peak. If you want to know what's going to happen to U.S. production, hurricanes notwithstanding, but sort of in a more general way, I think that the really great indicator to look at is the Baker Hughes oil rig count. Basically, when that starts dropping, about 4 months later, we start seeing a drop-off in U.S. production. And when it begins rising, about 4 months later, we start seeing a rise in U.S. production. So basically, between the time they start using a drill to get a new oil well, it takes about 4 months on average for it to become productive. Now, sometimes it's faster, sometimes it's slower, but 4 months is a great sort of average number for it. U.S. is now seeing this huge surge in investment in the last 15 months. In the last 12 months or so, since the end of October last year, we've seen an enormous surge in production. It's come back up to our record high from early 2015. But the number of oil rigs is now starting to taper off. The productivity of those oil rigs is starting to fall. And so I think we're getting right near a little peak here in U.S. production. And so, I think that U.S. production surging helped to offset a lot of OPEC's cuts. OPEC cut 1.5 million barrels per day, and most of that was replaced by increased U.S. production. So now U.S. production might kind of stagnate for a while, maybe even decline a bit. If that happens, in general, that should be bullish for prices, except that I think that the likelihood of OPEC starting to cheat on their quotas is going to grow. So, I think that in a sense, U.S. production and OPEC have been offsetting each other. OPEC has been bullish by cutting production. The U.S. was bearish by raising its production. Now I think that those roles might reverse. I think that the U.S. production is going to peak out, which would normally be good for oil prices, but I also think OPEC might start cheating, which is potentially bad for oil prices. So when I look at the oil futures market, what I see that I think is very interesting is how flat that curve is. It's flat as far as the eye can see. It says prices are going to be near $50 per barrel for the best part of the next decade. And so the market sees the upside and downside risks as being very evenly balanced. But what I would point out also as we get ready to talk about oil options is that the options volatility on oil, even though it's way, way off its highs, unlike metals, unlike interest rates, equities, or currencies, it's also nowhere near its all-time lows. It's kind of in the middle of its range. It's still showing 25 to 30% implied vols on a lot of these WTI options. So it says, okay, $50 might be the average price, but there's an enormous probability distribution around that. And so I think that the upside risks to oil are in part political. There's a potential for disruption in places like Venezuela and Angola and Nigeria and Algeria and all the sort of unstable countries that are big oil producers, not to mention, of course, the Middle East. And then you also have the fact that inventories are dropping, which I think is bullish, which means that essentially that demand is starting to grow faster than supply. On the bearish side, I think you have just the fact that inventories, even though they're falling from extremely high levels. And we have inventories that remain far, far larger now than they have been historically. And that's, I think, is pretty bearish. But the market seems to think that those risks are relatively evenly balanced, that oil is going to stay around 50, but that there are huge, huge both upside and downside risks to that sort of central forecast.
Eric, it's a good point about crude vol, because we've mentioned many times on the show. Crude vol is certainly hovering around the recent lows, which is, of course, the last year or two. But you have to look at a little bit more of a almost geological time frame when you're looking at crude vol. And you go back a little bit, obviously, you're right, we've seen crude vol much lower. So people who are newer entrants to the crude market, I think there are quite a few of those who've come in over the last year or two. This could seem to be, apocalyptically low levels of volatility, but you have to go back a little bit in time and you realize this is nowhere near as low as it can go. And we certainly saw crude vol dipping low again this week. As we said before, that upside tends to equate to a little bit of downside in the vol. That's exactly what we saw this week. Like we said, crude finishing the week north of that 50 handle. It seems to be the boost that the crude volume needed. Open interest is pretty strong this week, up about over 5%. But the vol, like we mentioned, taking it on the chin off multiple points across the term structure here. So quite the vol drubbing. All of you out there who've been writing into us, asking us when will crude vol rebound. All of you who've been leaning on the premium buying side of the fence, perhaps not the best week for you guys, unless, of course, you were betting on that perhaps inevitable upside break over the 50 handle, in which case you were perhaps a happy camper this week. Who else were happy campers? Were all of those folks out there slinging the Nove contract out here this week, which is where the number one with the bullet comes in here. The Nove doubles, the Nove 55 calls leading the action with over nearly 16,000 of these lighting it up. So pretty action-packed, including about 5,000 on Wednesday and 5,000 on Monday. So 2/3 of the volume coming on those two sessions. And right on its heels were the 50 puts. So we said before, crude likes to be kind of in these even strike ranges, and we see that with the options week after week, and we see it again this week. 50 puts also out there in Nove doing nearly similar numbers, nearly 15,000, 14.6 or so, with the lion's share actually coming today, 11,500 of these printing today. Pretty active day for the 50 puts. Both of these net opening on the week, though not tons, so a lot of closing paper out there throughout the week as well. Then we drop off a little bit to our number 3, which are the 45 puts. So they used to be, we were talking 50-45. That was the strangle. That was the risk reversal. Everyone seemed to be fixated. Now that we're north of 50 handle, it seems to be 50-55. But we haven't forgotten about the 45 puts. They were doing about 14,000 contracts this week, including the lion's share coming actually pretty evenly on Wednesday and Thursday, about 36, 37, 3,800 on both of those days. So pretty active days out there as well. And then we get a little bit farther out. We also saw the 54 calls trading nearly 11,000 contracts out there in DESA this year, and a little bit of downside. The downside lovers weren't left out as well. June 2018, the 40 puts doing nearly 10,000 contracts this week. And we get farther down the supply chain there all the way out to DESA of 2018. We saw 11,000 of the 35 puts going up this week as well, which is a pretty interesting print. Let's see if we can dig in here a little bit to see how much of that was opening, if my system will play along with me. And looking farther out than that, we see, the 40 puts, and beyond that, not a heck of a lot. Also not a lot really this week in the weeklies. I'm waiting for this to open up on me, Mr. Nick. Why don't you break down what you saw this week out here in the quick skew? What was going on? As I mentioned, the vol taking a drubbing. We see a big change in the quick skew this week?
What do we see? So we see a little bit of a difference from DESA out from last week, but really we're seeing the big difference in the Nove. That's we're at like 32 days, so we can compare that to the 30-day constant maturity. But we saw the puts get bid this week, and we saw the calls get offered. And again, that is probably in line with what you expect as we run up toward what people might think is going to be our high level for a period of time, or our balance point, as Erik mentioned. And then, there starts to be some sentiment that I'm going to get prepared for the next move down, because we really have been staying within a very tight range here. So that's probably the most interesting piece going on. Overall volatility is down on the week quite a bit. And again, Mark, you and I talk about it more often than we don't talk about it, is we get these little moves, these 2% moves, these 4% moves, 5% moves for the week. But typically in a day, you get a 2%. You need another 2%. It feels like in the underlying to start to get some activity from a vol pressure to the upside. But really, there wasn't that kind of action this week, and it looks just like people positioning again, at least from in the short term, positioning for an increased positioning for the downside in the short term. But prior to that, it was a pretty balanced, as Erik mentioned, a pretty balanced sentiment starting last week of which way the direction was. But as of right now, it's still sort of positioned to the puts being a little bit more, significantly more bid than the call. So a much steeper slope between the 25 delta put and call. I will ask this one question of Erik, if he can talk to, we when we look at the historical volatility on the crude, it's much lower, years back, but it's much lower at a higher price. So, I mean, that has something to do with the lowness in the volatility, right? So can you talk about how you would maybe look at that from, to normalize that a little bit with a 10 vol when it's 106 versus a 25 vol when it's 50?
Yeah, exactly. So this is a problem that we face in other markets too. This isn't really the case for our interest rate futures, but if you're trading swaptions, for example, and options on swaps, if interest rates are say 10% and they move 1%, that's like a 10% move, right? But if interest rates are 2% and they fall to 1%, that's like a 50% move. So in a sense, crude has sort of an analogous problem in the sense that, if you're at $100 a barrel and the price drops by 5, well, it's only a 5% move. Or if you're at 50 and it drops $5, that's a 10% move. So yes, it's true. I think that that probably does have something to do with the level of volatility. So I don't think it's realistic to expect that crude oil options are going to go down to like 14, 15% implied vols. from their current levels, which are almost double that. But that's essentially where they were before oil prices crashed. In 2013, 2014, that's where volatility was trading. That said, I think that there is probably some potential for implied volatility to go lower if the market remains really trading in a very, very tight range. Eventually, you have very low realized volatility that tends to drag implied volatility lower unless the market's perceiving some sort of forward risk that's upcoming, which may be doing given the instability in some of these oil-producing countries.
Let's move on. We got a little bit of time left here. Let's get into really quickly before we do that, you guys like your winners and losers. Let's hit on your winners and losers for the week. Number one with the bullet this week out here was Nat Gas, up nearly 7%. Again, this is just pure underlying. We're not looking at vol or anything else like that. Just pure underlying on the week. Nat Gas taking it with nearly 7%, followed by WTI. Good week for WTI, as you just outlined, up over 6%. And then on the downside, we got lean hogs off nearly 6%, 5.83%. And then iron ore right above it with about 4.6%. We've got a little bit of time left. Let's see if we can squeeze in a few of your questions in our futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/The Options Insider, stocktwits.com/Options Insider, or via questions@theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live every Friday at 3 p.m. Central via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's MIXLR.com.
All right, everybody, welcome to the feedback, the portion of the show where you guys get to take the reins. We ask questions. You guys ask questions of us. Let's pay off our question of the week here. Eric, I think you'll find this one interesting. We asked our audience here at the beginning of the week, with Q4 is looming, where are you guys placing your bullish volatility bets? So which of these sectors do you feel has actually the most upside? Actually, we did that last week. That's the payoff for last week. We'll save that. We already kind of paid off some of that last week. We need to get the question actually from this week, which is along similar lines. I'll pull it up right now here, and then we'll get into it. Let's see. My systems are all playing havoc with me today. Here we go. All right. So, yeah, we asked our people this week. Obviously, disaster is on a lot of people's brains this week, of course, with Harvey and then Irma and then Jose. And we typically hear people talking about prepping their houses or their cars or their families for disasters. We very rarely hear about them prepping their portfolio. So we gave them 4 choices. So how would you like to prep your portfolio? Do you want to get long some volatility? It could be in VIX or some other product like that. Do you want to just go to cash or to T-bills? Would you rather buy some index or stock puts, to hedge your long position but stay long? Or do you want to switch into, let's say, the risk assets like gold? Mr. Eric, we'll start with you as our guest here. If you had a choice of those 4, which would you think you'd be most acclimated to? And then what do you think our audience, more importantly, what do you think our audience is voting for?
Oh, I don't know. That's a good question. I think that gold options now are looking pretty interesting. I think that I'm not sure what the potential of an enormous move in gold in the very short term is, but I think that those options could be potentially very, very interesting to look at, given that they're trading at such low levels. Not the lowest ever, but certainly near the low end of their historic range.
So 1 vote for gold there. Interesting. Mr. Nick, what are you feeling there? You like volatility, cash, and T-bills, hedging with index or single-name stock puts, or getting into the quote-unquote risk assets like gold?
Yeah, I have interesting perspective on it because I think I would love for the S&Ps to have a big downside move, but it just doesn't seem like it's going to happen. Me personally, I like the T-bills and the metals myself, given where the stock market is. But clearly, I would have been on the wrong side of the profit equation with that. But I would reiterate what Eric had to say. You and I speak a lot about the gold options at these levels, especially when we see them come off of off the high end of a range that has been hit. And since we were down so much this week, another move down will start to put some, if we settle back into that middle of the range that we're in around the 1300 mark, those puts get a little bit soft. And then I like getting on those puts and hedging them, because you got a low volatility. If you get some upside move, you got a low vol with the gamma. And if you get a downside move where something actually happens where we continue to go lower, you got cheap volatility. So if I sound like a broken record when it comes to that, but trading these ranges, that seems to me to be the easiest thing to do.
This is a rare moment where our audience is deeply indecisive. It's a three-way tie of 28% for getting long vol, buying index puts, and buying risk assets. So they can't tie. All three have 28%, only 16% wanting to go to cash. So usually our audience, I know earlier in the week, index puts, I think we're leading the charge. That seems to have lessened as we get. You got another day or so if you haven't voted yet. Let's see, we got a few more here. Let's go to Uriah. Uriah wants to know, hey, I think a CME should do an updated version of the collar study, but on futures options. There are a lot of markets on the CME platform that seem well suited to collar trading. Well, Uriah, you wrote into the right show because we have Erik on. He's a man who kind of heads up a lot of the research over there, him and Blue over there on the CME research team. Erik, I'm not sure if you're familiar with this. We talked about this on recent shows. A study that our friends over at the OIC did probably about 5 or 6 years ago now. It's a little dated, but they did a study on collars and effectively the efficacy of collars across a broad array of assets. And they usually structured the collar as buying, I believe, a 6-month put and then selling a 1-month call and then rolling that every month and doing that across a broad array of assets. They started off in the Qs when they moved out to gold and to the treasuries and to you name it to currencies, et cetera. And they got a lot of data as a result across a broad variety of asset classes. And it seems like our audience really seems to have resonated with them. A lot of people writing in and asking for more data on that and for any updated versions of that study. All of that, Erik, is a long way around to asking you on behalf of Uriah here and some of our other listeners. Is that something that would maybe interest the CME research team, maybe going back? And because there hasn't been a study like that since that one, that was many years ago now, so the data a little bit dated, pun intended. Is this something that would interest the CME research team to go out and looking at maybe how different option strategies perform, particularly on the commodities, because they seem to be very well suited to these collar strategies?
Yes, I think that would be fascinating to participate in a strategy like that. I think maybe we can partner up with quickstrike, or certainly use the quickstrike tool to see if we can do that. Quickstrike has great data on essentially every single one of our major markets here at CME. It goes back to, in most cases, back to January 2011. So that would give us over 6 years of data. I think it would be very, very interesting. I've not looked into that, but thank you for bringing that to my attention, and I'll make a priority of looking into it. We have a busy schedule, so I can't guarantee I'll get it out quickly, but I will definitely take a look.
Uh-oh. See, you're going to regret coming on this show now, Erik, because you're going to leave with homework as a result. Nick, what do you think about that? You think about this, maybe a collar study might be kind of interesting?
Yeah, I think there's some stuff we can do. And Erik, I think on the upside of that whole thing, I think we're going to start pushing that date range back to the beginning of 2007 in the near term. So most of the benchmarks will probably get to that January of 2007. So that's something, right, I guess, to look forward to. Yeah, you know how I feel about skew. I like, I have my skew war stories, and I like paying attention to skew. And I think either a report of some sort, or tracking a trade over a period, tracking a similar trade over a period of time, like doing something like that. We have some tools that will allow us to do that as well already. So just making those a little bit more formal, I think, would be pretty interesting. And we're always trying to find different ways to look at volatility, especially when it comes to the delta-based vols and the consummatory.
Since we're talking skew, we'll wrap up on this one. This comes from Tomseh. He or she wants to know, hey, this is actually what you and I were talking about yesterday, Nick. He wants to know, can we get a quick strike skew index that we can track and trade? I think you guys are working on just that, aren't you, Nick?
Yeah, I mean, we look, a lot of, you like to look at a lot of stuff, and then it becomes what's practical and what seems to, what might make some sense for everybody. But yeah, we are trying to look at some measures that are a little bit more formalized. We like to think of quick skew as an index, because you can look at it over time, and it gives you some ability to make some judgment based on where things are versus where they were. But yeah, we've been talking about some quick skew or quick strike branded indexes across the different asset classes as well.
All right, listeners. Unfortunately, that music means we've come to the end of another epic journey through the world of futures options. It's amazing how fast an hour flies by, particularly when we're talking fun research over there. But before we go, let's go back around the horn one more time, see what everyone's working on. Eric has alluded to a lot of the papers he's working on. We've already given him homework for his next appearance. He has to come armed with some collar data. That said, Eric, when you're not busy looking at gold and other things, what else do you guys have on the docket from coming out of the CME Group research team in the coming months?
Well, we're very interested in looking at what's happening in Europe. The Germans are about to have their elections. The result of this election, we think, is a foregone conclusion. Angela Merkel will be returned to power. But after she gets back in power, there could be a lot of changes going on in Europe. Germany might take a more fiscally expansionary stance, et cetera. That can have really big consequences, obviously, for the euro-US dollar exchange rate, but also for our interest rate markets, et cetera, in part because one of the reasons why Treasury yields aren't higher is because the competing products around the world, whether it's JGBs or German bunds, the yields are so much lower that investors are coming into our products in the U.S. in search of yield. But if they alleviate some of their problems, that sort of buying impetus for U.S. debt could disappear, and we could wind up with significantly higher long-term interest rates, which has, I think, really big implications for stock valuations, for real estate, for other sorts of things. So that's definitely one thing we will be looking at, I think, in the near future. Another thing is China's yield curve has inverted, and I think that indicates that they're going to have a slowdown in economic growth sometime maybe towards the middle of next year. That could have a huge impact on copper and on copper option volatility. So that's another area to look at.
There you go. Check out all the research coming out of Eric and Blue and the rest of the team over there at CME. Head on over, easy to find, cmegroup.com. Click around, you'll find the research, including the paper we just broke down today earlier on the show entitled Gold Risk from Diminished Rate Expectations. And Mr. Nick, we just alluded to, you guys are working on some cool quick skew stuff. What else is coming from you guys in the Quick Strike team these days? I think we have to work on Nick getting a new mute button. That might be the best way to proceed. Mr. Nick, what are you cooking?
You know
One
what?
more time, sir.
Again, 10 seconds of gold, and now I'm shocked. No, like I mentioned, I think a couple weeks ago, and I think we were a week behind on actually making it happen, but quick skew is now out there, but it was sort of a secret thing that we had in the reports, but there wasn't any charts for history or anything like that. But we officially released that unfortunately, only into the subscription versions at this point. But as a precursor to some other stuff that's going to be coming on, you'll hear us talk about quick vol tool and that type of thing. So we'll be formalizing quick vol as its own sort of standalone tool as well. And with that, we will accommodate a little bit of a free version of that as well. So you can get a taste of the different tools that are in there. You'll get a very short amount of historical time, but it'll give you an idea of what's available. So that's in the pipeline as well. That should be sometime early next quarter. And then finally, we put out some new stuff for the COT report, so you can start to track futures against the open interest and the large trade numbers. And then an interesting one that we put out there, and it's just something I thought might be that people want to look at. We put out a ratioed bar chart that shows the change in OI over the volume, so you can kind of get an idea if an expiration is churning, or if a product itself is churning, or if that volume is generating new open interest. Now you can look at that and you can look at the numbers, but it's really nice to kind of see it and sort of get an idea of where the closings were and where the openings were. So if you go take a look at the vol tool, you'll be able to, or the vol tool in the public side, or the quick options chart on the subscription side, you'll see that new chart available there. So a bunch of new stuff's getting pushed out there. So it's we're past the summer lull, and I think you're going to see a lot more interesting things coming in the next quarter and a third.
There you go. Interesting things coming from the Quick Strike team. Easy for me to say. Check it out if you want. Kick the tires all week long. CMEgroup.com/TWIFO. Easiest way to get the free. Check out the tools for free. And then, as Nick alluded to, if you like what you see there, you can always upgrade down the road. Now, on behalf of Nick and Eric and indeed myself, I want to thank all of you out there in the listening audience for downloading, streaming, and subscribing, and of course for joining us live. We love you guys too. And we'll see you next week for more of This Week in Futures Options.
This Week in Futures Options is brought to you by QuickStrike, options pricing and analysis software. QuickStrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. QuickStrike has you covered with market data reports ranging from open interest to the term structure of volatility. QuickStrike is the perfect addition to your trading toolkit. Learn more about QuickStrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1. This Week in Futures Options is also brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.